Hi, welcome once again to Auditing 304, Session 7, Evidence Gathering and Documentation. The focus of a financial statement audit is to enable the auditor to express an opinion whether the financial statements are prepared in all material respect in accordance with an identified financial reporting framework. Such opinions must be based on sufficient and appropriate audit evidence documented for further reviews. This session seeks to introduce students to evidence gathering, sufficient and appropriate evidence, and documentation. At the end of the session, students are expected to be able to explain the meaning of sufficient and appropriate audit evidence, discuss risk assessment and test of controls involved in evidence gathering, describe sampling in auditing, identify and explain other means of gathering evidence, discuss documentation in auditing. The session will follow the following outlines. Read chapters 7 and 10 of the recommended test, Auditing and Assurance Services in Ghana by Bedi. You can also pay attention to the slides, and don't forget to read any other auditing and assurance textbooks available to you. Concept of audit evidence. It is the information used by the auditor in arriving at conclusions on which the audit opinion is based. It includes all the information contained in accounting records underlying a financial statement. It includes all audit evidence obtained from audit procedures during the course of the audit, may include evidence from previous audits. I hope you've not forgotten this, the financial statement assertion. The 7 assertions that we identified earlier on in session 1 cover MP. Yes, you remember now. Completeness, occurrence, valuation, existence, rights and obligations, measurement, presentation and disclosure. We said that the financial statement that have been prepared by management is making these assertions. Therefore, the opinion auditors are going to issue is either to confirm these assertions or not. And therefore, auditors need to gather evidence. And evidence is what we are looking at this moment. So the management assertion, we say the use of assertions is in obtaining audit declarations. Assertions used could be about classes of transactions and events. That is, that all transactions and events that should have been recorded have been recorded. Here we are referring to what? Completeness and occurrence. That all amounts relating to recorded transactions and events have been recorded appropriately. Here we are talking about measurement, about account balances at the period. Here, asset, liabilities, equity, interest exists. Does it indeed exist? That we are talking about existence. Is the assets for the organization, liabilities, equity. Assets and liabilities are included in financial statement at appropriate amount. That is, have they been valued appropriately? Asset, liabilities, and equity are truly that of the organization. That is, do they have the write-off? Are they obliged to pay as a liability? That is right and obligation. About the presentation and disclosure, financial information is appropriately presented and described and disclosures clearly expressed. That is presentation and disclosure. All disclosures have been included in a financial statement. That is what? Completeness. So whatever you find in a financial statement is making one of these assertions. And that is what we are seeking to look at. So let's turn our attention back to audit evidence. What is sufficient evidence and what is inappropriate audit evidence? If we are talking about sufficient and appropriate audit evidence, for sufficiency, we are referring to what? The quantity of the evidence gathered. And for appropriateness, we are referring to what? The quality of the audit gathered. The higher the quality of audit evidence available, the less the evidence that may be required. So, a given set of audit procedures may provide an audit evidence relevant to some assertions, but not others. Example, inspection of records and documents related to the collection of receivables after the period may provide evidence regarding existence and valuation, but not cut-off, not completeness. The auditor often obtains evidence from different sources or different nature relevant to the same assertion. Example, analyzing aged accounts, receivables, and subsequent collection of to obtain evidence relating to the valuation of provision for doubtful debt. Again, obtaining an evidence relating to a particular assertion is not substitute for another assertion. Example, evidence for the assertion of physical existence of inventory cannot be a substitute for valuation of evidence of inventory. What does this tell us? This informs us to, as an auditor, to gather enough evidence and to gather sufficient or appropriate evidence in terms of the quantity, that is sufficiency, and quality, that is the appropriateness of the audit evidence. There are certain generalizations when it comes to audit evidence, that is about reliability of the evidence. We say that audit evidence is more reliable when it is obtained from independent sources outside the entity. Audit evidence that is generated internally is more reliable when related controls are imposed by the entity are effective. That is, if the internal control systems are effective, then the evidence coming out of it, that is the output out of it, is appropriate evidence. And also, if the auditor obtains evidence outside the entity, for example, external confirmation, that will be what? Enough evidence, or that will be appropriate evidence or reliable evidence than when taken from management themselves. Audit evidence obtained directly by an auditor is also very reliable. Audit evidence is more reliable when it exists in documentary form. So, for auditors, the most important thing is that everything needs to be documented. Audit evidence provided by original documents is also more reliable than audit evidence provided by photocopies. So this will help us to look at the reliability issues in audit evidence. We are saying that most reliable when the physical document exists, and least when the client is the one giving you the evidence, in possibly on oral or in the form of any other representation. And then beside it is the example. So physical, we are talking about inventory observation. The auditor himself or herself attending the inventory count, possibly did it him or herself or as a team themselves. And then the least one, that is the client representation. Example is what? Letter of representation or from management. Audit procedures for evidence gathering. That the procedures adopted must allow the auditor to undertake the business and its environment, including risk, to test controls and to detect material misstatement. That is, any procedure adopted by the auditor should help the auditor to do this. Understand the business and its environment, to test controls and to also detect material misstatement. One key thing, procedure that the auditor can use or strategy is a substantive test. It is a test of details of transaction or balances, an analytical procedure performed by the auditor to detect material misstatement in the account balances, transaction class, and disclosure of components of financial statement. There are several types of substantive tests. Can be inspection of records of document, inspection of tangible assets, observation, inquiry, confirmation, recalculation, reperformance, and so on and so forth. And also analytical procedures, which is analysis of significant ratios and trends of relationship that are inconsistent with other relevant information or deviates from predictable amount. Also, there's also the risk assessment procedure. That is, the auditor performs the following risk assessment procedures to obtain an understanding of the entity and its environment, including the internal controls. That is to very much appreciate the environment, the industry, and how things go about in the entity to inform the kind of evidence the auditor should gather. The auditor can look at inquiries of management, that is, discuss issues with management and others within the entity, use analytical procedures, observe and also inspect certain documents, discussion among the engagement team to also understand some of the evidence they've gathered throughout the process. Test of controls, what are these? So that it is a test directed towards the design or operation of an internal control policy or procedure to assess its effectiveness in preventing or detecting material misstatement in the financial statement assertion, also referred to as compliance tests. So procedures for testing of controls employs internal control questionnaires, or you can examine reports on the controls, usually by internal auditor, inspection of documents supporting various transactions, a walkthrough test, that is, the auditor performs a similar transaction to see how the output will look like, observations and inquiries. There are other forms of gathering evidence, management representation. That is, if management refuses to provide a representation that the auditor considered necessary, this constitutes a scope of limitation, and the auditor should express a qualified opinion or disclaimer. Don't get confused. We are going to look at the various opinions of auditing when we get to session 10. We can also gather evidence from attendance at fiscal inventory counting, inquiry regarding litigation and claim valuation and disclosure of long-term investments, segment information, related parties, and external confirmation. I'm very much interested in external confirmation, so let's try and throw some more light on it. Audit evidence is more reliable when it is obtained from independent sources outside the entity. Audit evidence obtained directly by the auditor is more reliable than audit evidence obtained directly or by inference. So therefore, audit evidence is more reliable when it exists in documentary form. Audit evidence provided by original document is more reliable than audit evidence provided by photocopies and facsimile. And therefore, if it is gathered outside, or confirmation comes from outside the entity, it therefore is very much reliable. Therefore, external confirmation comes in two forms: positive confirmation and negative confirmation. Positive confirmation is just that the respondent is to reply to the request in all cases. That is, if it's true, reply. If it's not true, still reply to the auditor, and then the auditor will form an opinion thereof. Negative confirmation is that only reply if you disagree. So the auditor is seeking to confirm something and asks that external party. If the external party disagrees, then the external party will write back to the auditor. If the external party agrees, will not reply the confirmation or the request. External confirmation can be used in several areas: bank balances and other information from bankers. So I can request the bank statement of the entity I'm auditing to verify some of the bank transactions they claim they have undertaken, and that statement I'm getting serves as a external confirmation. I can receivable balances. I can call some of the debtors to speak to, indeed, whether they owe the entity I'm auditing or not, and several and others. I will entreat you to read more. Now let's turn our attention to audit sampling. Remember, the auditor, depending on the size of the audit firm and the size of the entity, cannot do a substantive test, cannot do 100% virgin, and therefore sampling is accepted in auditing. Sampling is the application of audit procedures to less than 100% of items within a population. Here we are saying that within the entire population of the financial statement and the various documents surrounding it, the auditor may not be able to vouch all of them, may not be able to look at all of them, but takes a percentage out of the population and works it. If that is done, we're calling it audit sampling. The objectives of audit sampling is to obtain and evaluate audit evidence about some characteristics of items selected in order to form or assist in forming a conclusion about the population. In sampling, the audit must first consider the specific objectives to be achieved and the combination of audit procedures to be used to achieve the audit objective. Auditors should determine sample size sufficient to reduce sampling risks to an acceptable low level. Auditors should also select sample items in such a way that each sampling unit in the population has a chance of selection. There are two broad approaches of sampling: non-statistical sampling and then the statistical sampling. For non-statistical sampling, auditors use professional judgment to select items for qualify as a sample. And then for statistical sampling, sample items are selected at random. So each sampling unit has a known chance of being selected. There are several methods of sampling. Can be the random, the systematic, the haphazard, the block, the stratification, and value-weighted selection, and several other sampling methods. read to appreciate more of these and know more as well. Now let's turn our attention to the documentation. Remember, we said evidence gathering and documentation. Documentation is a very important part of the work of the auditor. What is it? The auditor must prepare on a timely basis audit documentation that provides sufficient and appropriate record of the basis for audit test report. Remember, we said based on the evidence gathered, the auditor will form his or her opinion, which will be written in the audit report. And we are saying, therefore, that a sufficient and appropriate record of the basis for the opinion should exist. Evidence that the audit was performed in accordance with applicable legal and regulatory and professional requirement. Audit documentation is very important, and therefore we're saying that the purpose of audit documentation is one, assisting the audit team to plan and perform the audit. The available documents that will help the auditor plan easily. Assisting members of the audit team responsible for supervision to direct and supervise the work of audits and to discharge their review. Enable the audit team to be accountable. With the existence of documentation, the audit can be reviewed, can be evaluated, and therefore the team will be accountable to their actions or the work they are doing. There are several other purposes for audit documentation that I will entreat you to read more. What is the nature of audit documentation? We're saying that audit documentation may be recorded or on paper or on electronic or any other media form, which may include audit programs, analysis, issues of memoranda, summaries of significant matters, letters of confirmation and representation, checklists and correspondence, and so on and so forth. The file must be properly outlined and referenced because documents will be later checked or searched to support what the auditor is doing, and therefore must be properly filed and referenced, and for easy access and for easy location. Documentation, remember, is a continuous process. It doesn't begin at a point and end at a point. It goes along with the phases of auditing. Now, the next thing I want us to pay attention to is the risk model. Remember the strategies of auditing? The risk model was part of it. So what is it? We are saying that audit risk is basically the risk that an audit or an auditor may issue an unqualified opinion on materially misstated financial statement. That is a financial statement that is skewed, a financial statement that is materially misstated, a financial statement that has issues that do not qualify for certain assertions. The auditor may issue a report to say that it's good, it's true, it's fair. When that happens, that is what we are calling the audit risk. So audit risk is the risk that an auditor may issue an unqualified opinion on materially misstated financial statement. The auditor assesses engagement risks first and then sets audit risks. The audit risk is inversely related to engagement risks. If the auditor accepts a client with high engagement risks, the auditor must conduct a more rigorous audit, and therefore the auditor does this by setting audit risks at a low level. If the auditor accepts a client with low level engagement risks, then the auditor can be free, and therefore audit risk can be high in this state. Audit and materiality. Remember, when we discuss materiality under planning, we said we will discuss it further when we come to audit risks. Audit risks and engagement risks relate to factors that might encourage someone to challenge the auditor's work. For example, transactions that might not be material to a healthy company might be very much material to a bankrupt or a struggling company. The following factors help to integrate the concept of risk and materiality. All audits involve sampling and cannot provide 100% assurance. Auditors must compute in an active marketplace for clients. Auditors need to understand society's expectation of financial reporting and audit process. Auditors must identify the risky areas of a business to determine which amounts are susceptible to material misstatement. Auditors also need to develop methodologies to allocate overall assessment of materiality to individual account balances. Now let's look at the audit risk model. Audit risk is a function of the inherent risks, a control risk, and detection risks. So let's move on to know what these various risks are. Detection risks. Risks that the audit procedures will fail to detect material misstatement. That is, relates to the effectiveness of audit procedures and their application. Detection risk is controlled by the auditor and is an integral part of audit planning. The level of detection risks set directly determines the rigor of a substantive audit work performed. The second is the inherent risk, which is the susceptibility of transactions to be recorded in error. That is inherent in the transactions themselves. Then control risk. Risk client controls will fail to prevent or detect material misstatement. That is, the quality of controls often varies between classes of transactions. The auditor assesses control risks. The control and then the environment, the inherent risk constitute what we call the environment risk, since that has to do with the entity, and the internal detection risk has to do with the auditor. So audit risk is set inversely to assess level of engagement risk. After audit risk is set, the auditor assesses inherent and control risks. The auditor sets detection risks inversely to environment risks. Example, if the auditor is examining transactions with high inherent risks or weak controls, the auditor will set a low detection risk. Low detection risk means a low probability of not detecting material misstatements. Therefore, to achieve low detection risk, the auditor will have to perform more rigorous substantive testing. For example, large sample size may more reliable forms of evidence, assign more experienced auditors, closer supervision, greater year-end testing, and so on and so forth. The audit risk model therefore shows that the amount, nature, and timing of audit procedure depends on the level of audit risks an auditor assumes and the level of client-related risk. But it has some limitation, saying that the inherent risk is difficult to formally assess. Audit risk is subjectively determined. We already said that the inherent risk is embedded in the transaction and activities of the entity. The model treats each risk component as a separate and independent when clearly this is not the case. Audit technology is not so surprised that each component can be accurately assessed. Because of these limitations, many auditors use audit risk model as a functional rather than mathematical model. So this brings us to the end of session 7. Have a good day.